Have you ever wondered if it's really possible to retire comfortably after 60 without draining your bank account? In this video, I'm revealing 4 powerful strategies that can shield your savings and give you lasting financial security. Miss these tips, and you might find yourself scrambling for income when you least expect it. Stay until the end to uncover the little-known secret that can make or break your retirement plan. Before we start, tell us where you're watching or listening from. Tip 1. Thoroughly evaluate your current financial status. Understanding exactly where you stand financially is the bedrock upon which every successful retirement strategy is built, especially if you're taking these steps after the age of 60 and feel an urgency to ensure your long-term well-being. It begins with a detailed accounting of all your monetary assets, liabilities, cash flow patterns, and any potential gaps that might hinder your ideal lifestyle going forward. This thorough examination allows you to see beyond mere savings totals and truly grasp how your income might align with your projected day-to-day costs, such as utilities, healthcare, groceries, and other core expenses. A key part of this deep dive involves checking your outstanding debt, if you still have any, and evaluating ways to reduce or eliminate those obligations before they become a major hindrance in your retirement years. By clarifying exactly how much money you owe, to whom, and under which terms, you can map out a timeline that helps ensure those debts won't eat into your discretionary funds when you no longer wish to work full-time. Another central factor in evaluating your financial status involves a candid look at your current monthly and annual budget, which must include everything from mortgages or rent and taxes to smaller monthly fees like streaming subscriptions or gym memberships. Many retirees discover that small expenses add up quickly, so analyzing and pruning unnecessary costs can help preserve much-needed capital for more critical needs down the line. Taking an objective view of your investment portfolio, whether it's composed of stocks, bonds, mutual funds, or real estate, is equally crucial because it indicates how your assets can potentially appreciate, how stable they may remain, and whether or not they could be liquidated easily in case of emergencies. If your portfolio appears too volatile or too heavily reliant on a single sector, it may be time to rebalance assets to reduce risks that come with market fluctuations. Banking and brokerage statement from the past 6 to 12 months, along with a recent credit report, can further paint a complete picture of your solvency, exposing any patterns of overspending or highlighting areas where you've been efficiently saving. With an honest assessment of your current standing, you can begin projecting how many years of retirement your nest egg can sustain under different scenarios, including best case, worst case, and most likely outcomes. This sort of scenario planning can incorporate factors like inflation, cost of living adjustments, and even changing personal goals, such as traveling in the early years of retirement or downsizing into a smaller home. If you plan to continue working part-time or running a small business after 60, factor in your expected earnings to create a more accurate snapshot of your future cash flow. While 65 has often been considered a standard retirement age, many people choose to work longer to maintain healthcare benefits or to bolster their Social Security entitlements. So your personal strategy should account for the advantages of delaying retirement if possible. Evaluating your Social Security statement is another essential step, as it helps you understand your eligible benefits at different ages and how a few extra working years could significantly enhance your monthly benefit in the long run. There is also tremendous value in reassessing any pension benefits you may have from previous jobs or government agencies, since these can serve as powerful anchors of stability in your financial framework if they are still active. Consulting with a certified financial planner or retirement advisor can provide deeper insights into your situation, especially if you're dealing with complex assets, tax obligations, or estate planning concerns. That professional perspective might reveal beneficial strategies, such as utilizing catch-up contributions in your retirement accounts or rolling over old 401(k)s into more suitable IRAs with lower fees. Careful scrutiny of potential tax liabilities in your current and future financial structure can help you prepare for the possibility that you may end up in a higher tax bracket than expected, especially if Social Security benefits and investments combine to push up your annual income. If you own a home, consider whether selling it or tapping into its equity through a reverse mortgage could be a viable strategy, but be sure to weigh all associated costs and long-term implications carefully. Any significant life change, like relocating to a state with a lower cost of living or moving closer to family for support, should be evaluated not only for its emotional and social impact, but also for the effect on your overall budget. The act of comprehensively reviewing your current retirement accounts, including IRAs, Roth IRAs, and 401(k), S gives you a clearer picture of how each type of account might affect your finances at various stages, particularly when factoring in required minimum distributions. Taking stock of your post-retirement lifestyle goals, such as traveling internationally or pursuing passion projects, can indicate whether your existing funds are in alignment with those aspirations or if adjustments need to be made immediately. Maintaining an emergency reserve, ideally large enough to cover 6 to 12 months' worth of living expenses, is a prudent decision for retirees who want to avoid tapping into longer-term investments too soon. This cash cushion can mitigate the stress of unpredictable events, like sudden medical bills or home repairs, ensuring that one-off costs do not derail your financial plan. As part of your evaluation, consider the financial impact of caring for aging family members or supporting adult children, if those responsibilities exist, as these factors might require additional savings or insurance coverage. Investigating alternative income sources, such as rental income from a vacation property or turning a hobby into a small side business, could offer supplementary support to your primary funding streams. Performing a thorough risk assessment, taking into account your current health status and family medical history, offers perspective on how much you might need to budget for potential long-term care in the future. Reviewing any wills or estate plans you have in place is part of this process, because clarity in legal documents and beneficiary designations will help you avoid disputes and confusion when it comes time to execute your final wishes. Additionally, you should look at all types of insurance you carry, whether that's homeowners, auto, life, or disability, to confirm that your coverage is both adequate and cost-effective, given your current circumstances. If you have not already done so, it can be beneficial to consolidate accounts and simplify your financial picture to reduce the risk of missing payments or forgetting about certain investments. Tracking your progress at least once or twice a year, whether through spreadsheets or financial apps, ensures that you stay updated on your cash flow, asset allocation, and overall readiness for unpredictable changes in the market or in your personal situation. Even if you discover some less than ideal realities during this evaluation, such as insufficient savings or heavy debts, it's vital to confront them head-on rather than ignore them, so you can formulate a more effective remediation plan. Confiding in trusted friends or family members about your financial worries can also help, as they might provide ideas or moral support to reinforce better spending and saving habits. A key takeaway in this self-assessment is to acknowledge that it is never truly too late to restructure your finances, trim costs, or invest wisely, even when retirement is looming or has already begun. The more transparent you are with yourself about how much you have, what you owe, and where you want to go, the easier it is to set realistic targets for the coming years. Sometimes, you might find that your savings are in better shape than you initially feared, which can provide the motivation to keep refining your plan with greater confidence. Alternatively, if the data shows you're behind on your goals, you can immediately start making lifestyle modifications, such as downsizing your living arrangements or focusing on paying off high-interest debt before it becomes too burdensome. This critical stage of taking inventory sets the tone for the subsequent retirement planning steps you will implement, from diversifying your portfolio to setting aside funds for health-related contingencies. The biggest benefit of conducting such a thorough evaluation is that it empowers you with hard data rather than vague assumptions, allowing you to pursue a retirement plan that is both sensible and based on actual numbers. By taking advantage of any relevant tax breaks or programs designed to support seniors, you can better preserve your assets and direct your resources to areas that need them most. Even though the process of gathering and organizing these details might feel overwhelming, approaching it systematically can relieve anxiety and establish a strong baseline for future decisions. Over time, this clarity helps you make meaningful progress toward the peace of mind and security you deserve in your golden years, ensuring that every subsequent move you make is well-informed and aligned with your overarching vision. Remember, the objective of this first key point is to illuminate all aspects of your current position so that you can confidently shape your retirement plan around verified data and calculated projections, rather than guesses or fears. Tip 2. Diversify and protect your retirement assets. Diversifying your retirement assets becomes the natural next step once you've established a clear understanding of your current financial position, as it enables you to spread risk across multiple investment vehicles and reduce the vulnerability of your nest egg to market fluctuations. Many financial advisors recommend allocating funds among various asset classes, such as stocks, bonds, real estate, and even commodities, to shield yourself from the volatility that arises when you over-concentrate in a single sector or instrument. If you have the capacity to do so, consider balancing growth-oriented investments, which might involve a measured portion of higher-risk assets that offer strong returns, with stable, more conservative options that aim to preserve capital. This dual approach to risk and reward ensures that, while a part of your portfolio seeks to outpace inflation and generate earnings, another portion remains relatively protected from drastic market shifts. Mutual funds, index funds, and exchange-traded funds, ETFs, can be particularly appealing for retirees looking for built-in diversification, as they pool money from many investors to purchase a broad range of stocks, bonds, or other assets. Real estate, whether through direct property ownership, real estate investment trusts, REITs, or crowdfunding platforms, can offer both a source of passive income and a potential hedge against inflation, although it also carries its own risks, like vacancy or property devaluation. If you have a strong understanding of local real estate markets and enjoy some hands-on involvement, investing in rental properties might be an option, but it's vital to factor in repair costs, property taxes, and management headaches. Bonds, particularly those from government entities or high-quality corporate issuers, can provide more predictable income streams through interest payments, though they might not keep pace with high inflation if rates are low. It's equally beneficial to examine international investments, as global diversification can soften the blow of downturns in any one country. But remember to research international tax treaties, currency risks, and potential political or economic uncertainties abroad. Within your retirement accounts, you may find life cycle or target date funds that automatically adjust the asset mix as you move closer to your desired retirement age, gradually becoming more conservative to protect your accumulated savings. While these can simplify your investment management, it's wise to ensure that the fund's timeline and risk tolerance align with your personal situation, especially if you plan to retire later or sooner than the fund's designated date. If your employer-sponsored plans are limited in their investment choices, consider supplementing them with IRAs or Roth IRAs, which often provide a broader array of asset options and possibly greater tax advantages in the long run. Keeping an eye on fees and expense ratios is important as well, because high fees can erode your returns over time, leaving you with less capital to live on during retirement. For those still in the workforce post-60, catch-up contributions to IRAs and 401k as can accelerate your savings rate, allowing you to place more money into these tax-advantaged accounts each year. Tapping into professional advice can be helpful in refining your diversification strategy, but be sure to review the advisor's credentials, fiduciary status, and fee structure to avoid biases or overly aggressive sales tactics. With rising life expectancies, retirees must be particularly vigilant about longevity risk. The possibility of outliving their savings and a well-diversified portfolio helps mitigate this concern by supporting steady growth and offering multiple channels for generating income. You might also think about annuities, which can provide a guaranteed income stream for life, but make sure you fully understand the fees, surrender charges, and the specific payout structure before committing to any particular product. Maintaining some accessible liquid assets, like cash in high-yield savings accounts or money market funds, ensures you have resources on hand to handle urgent expenses or market downturns without having to sell off long-term holdings at a disadvantage. Over time, you should revisit your allocation strategy to rebalance assets when they stray significantly from your target mix, locking in any gains from outperforming sectors and reinvesting them in areas that have underperformed. This disciplined approach typically helps in staying aligned with your risk tolerance and overall retirement timeline, rather than letting emotional reactions to short-term market swings dictate your decisions. Protecting your assets also involves establishing defensive mechanisms, such as having adequate insurance coverage to shield you from catastrophic events like natural disasters, lawsuits, or major health crises. If you own significant assets, setting up a trust or a well-defined estate plan can safeguard your wealth for your heirs and potentially reduce the estate taxes they might face. Reviewing beneficiary designations on retirement accounts and insurance policies is a part of asset protection too, ensuring that your chosen individuals or charities receive benefits in a seamless manner. Additionally, you may want to explore legal instruments like durable powers of attorney to manage your financial matters if you become incapacitated, thereby preventing unscrupulous parties from taking advantage of your assets. Balancing the desire to leave a legacy with your personal need for comfort and security in retirement is another aspect of asset protection, requiring thoughtful planning and clear communication with family members. Just as in the first step of evaluating your finances, documenting these diversification and protective measures in writing helps ensure that your long-term strategy remains transparent and consistent. It also aids any financial advisors or family members who might assist you, making it easier for them to adhere to your wishes without second-guessing your priorities. Depending on your confidence and familiarity with different asset classes, you might opt to take a more hands-on approach to managing your investments, or you might prefer to rely on automated tools and professional guidance. Whichever path you choose, establishing some degree of regular monitoring, monthly, quarterly, or annually, prevents unpleasant surprises and helps you spot new opportunities. When executed diligently, this diversification step can stabilize your net worth against inevitable economic ebbs and flows, smoothing out returns and increasing the likelihood that you'll maintain the standard of living you desire in retirement. It's never too late to pivot your strategy if you feel overly exposed to certain market risks, or if your personal preferences shift, such as growing more conservative as you age, or deciding you'd like to pass on more of your wealth to your children or favorite charities. Looking into alternative investments like peer-to-peer lending or precious metals might also be appealing, though it's prudent to limit them to a smaller portion of your portfolio due to their higher volatility and complexity. Focusing on balancing growth with protection is a delicate act, but one that can significantly bolster your sense of security as you move forward into the later stages of life. Even if you have a modest sum saved, a multi-pronged approach that includes both stable and growth-oriented investments can help you navigate the financial landscape more confidently. Diversification also extends beyond just where you invest your money. It's about building multiple streams of retirement income, such as rental income, dividends, Social Security, pensions, part-time work, and annuities, so that any downturn in one stream won't completely derail your financial stability. By carefully maintaining a mosaic of financial vehicles, you can weather economic shocks with far greater resilience, which is particularly reassuring when you're no longer drawing a full paycheck. Seeking out the wisdom of credible sources, books, classes, or reputable websites further refines your knowledge and ability to make informed decisions about how best to distribute your assets. Remember that diversification isn't a one-time event, but an ongoing process that evolves with your life circumstances, market conditions, and personal ambitions, so staying open to periodic adjustments is wise. The ultimate goal here is to create a robust, sustainable financial infrastructure that can carry you gracefully through the next decades, enabling you to enjoy the freedom of a well-earned retirement without constantly worrying about the performance of a single stock or sector. Protecting your capital goes hand in hand with diversifying it, so don't neglect important legal and insurance measures that guard your wealth from unexpected events. This stage builds upon the knowledge you gained in the first key point, turning your awareness of your current standing into tangible actions that strengthen your retirement plan. As a result, you gain the peace of mind that comes from knowing you've spread your bets wisely, leaving less room for unforeseen circumstances to dismantle all you've worked for. With every small step you take in broadening and safeguarding your retirement portfolio, you're also reinforcing the confidence that your golden years will be marked by stability, choice, and the capacity to handle life's inevitable surprises without sacrificing your well-being. Tip 3. Secure healthcare and manage insurance plans. Examining your healthcare coverage is absolutely crucial for a secure retirement, as medical costs often increase with age and can eat away at even the most well-prepared financial plan. Whether you rely on Medicare, a private insurer, or a combination of both, understanding the nuances of your coverage ensures that you don't get blindsided by out-of-pocket expenses for hospital stays, medications, or specialized treatments. You should also consider the advantages of supplemental coverage, often known as Medigap, which can help fill the gaps that Medicare does not address, such as copayments, deductibles, and healthcare services received abroad. If you're already dealing with ongoing medical conditions, it's especially important to review your prescription drug plan, whether that involves Medicare Part D or a separate policy, because not all plans cover every medication in the same way. Staying informed about open enrollment periods, which typically take place annually, lets you adjust your plan if your health needs change or if you find a more cost-effective option. Another vital aspect of healthcare and retirement involves long-term care, LTC, insurance, which can cover the often substantial expenses of nursing homes, assisted living, and in-home caregiving. Because LTC premiums can be pricey, it's wise to research policies well before reaching an advanced age, keeping in mind that costs typically rise as you get older and develop more health conditions. Even if you decide that LTC insurance isn't right for you, either due to cost or personal preference, you should still have a plan for how you would fund any extended care needs that might arise. In some instances, hybrid policies that combine life insurance with LTC benefits can offer more flexibility and a death benefit for heirs if you never utilize the long-term care portion. Evaluating your life insurance needs is another cornerstone of a well-rounded retirement plan, as a policy can protect your spouse or dependents from financial hardship in the event of your passing. Depending on your situation, a term life policy might suffice, but many older individuals look toward permanent insurance for guaranteed coverage as long as the premiums are paid. If you have no dependents or your estate is substantial, you might conclude that life insurance offers limited value, though you'd still want to confirm that choice aligns with your broader estate and legacy objectives. Dental and vision insurance often get overlooked, but these are common areas where retirees might incur repeated out-of-pocket costs. So investigating supplemental plans or discount programs may yield savings down the road. Establishing a dedicated health savings account, HSA, can be another efficient strategy if you're still eligible, since the funds can grow tax-free and be used for qualified medical expenses even after you stop working. Maintaining a basic fitness routine, a well-rounded diet, and regular checkups should be a priority as well, because preventive care is arguably the most effective form of health insurance when viewed from a long-term cost perspective. If you have a family history of certain conditions like heart disease, diabetes, or cancer, take extra measures to manage known risk factors, as some insurers might consider you at higher risk. Securing adequate healthcare and insurance plans also means exploring community resources, such as senior centers or local health clinics, which sometimes offer discounted or free screenings, workshops, and health management classes. Telemedicine options have grown in popularity, enabling retirees with mobility constraints to consult doctors from home, though it's important to verify whether your insurance plan reimburses these services. Keep in mind that some retirees choose to relocate internationally to countries with lower medical costs, but it's crucial to research the healthcare infrastructure, insurance coverage options, and language barriers in that destination before making a move. Avoid waiting until a serious health crisis arises to learn the details of your plan, because last-minute realization of coverage limitations can result in enormous bills and financial strain. Periodically reviewing your insurance policies, probably each year, ensures that you remain aware of policy changes, premium hikes, and coverage modifications, empowering you to make timely adjustments. If you work for an employer that provides retiree healthcare benefits, confirm the stability of those benefits and whether they'll be enough to meet your needs, because some companies reduce retiree benefits over time. Creating an end-of-life plan, which can include advanced directives, living wills, or healthcare proxies, is another form of protection that helps your loved ones understand your wishes and can mitigate stress during medical emergencies. Organizing and storing all health-related documents, insurance policies, and contact information in a single place, either digitally or physically, makes it simpler for you or your family members to manage healthcare logistics if you become incapacitated. Planning ahead for potential expenses like hearing aids, wheelchairs, or home modifications ensures that you won't be caught off guard by sudden financial burdens. While insurance plans can provide robust coverage, building an emergency medical fund is still wise, as insurance might not cover all treatments, and the last thing you want is to compromise your retirement savings to pay for a vital procedure. Keeping up with recommended screenings and medical appointments helps detect issues early, when they're easier and cheaper to manage, ultimately saving you from bigger costs down the line. Being open with family about your health status, medical needs, and insurance details can ease coordination of care if it becomes necessary, especially if adult children or close relatives will be involved in decisions. If you plan to retire before becoming eligible for Medicare, be certain to research bridge insurance options, such as coverage through the Affordable Care Act or short-term medical policies, to avoid gaps that could lead to high bills from even routine medical events. Understanding the distinction between in-network and out-of-network providers can also help you choose doctors and facilities wisely, preventing expensive out-of-pocket charges that could arise from a lack of familiarity with your plan. Being proactive about mental health coverage is crucial as well, because issues like depression or anxiety can arise during major life transitions, including retirement, and addressing them sooner rather than later is both cost-effective and beneficial for overall well-being. By building a multifaceted insurance framework that accounts for everyday health needs, potential catastrophic events, and extended care scenarios, you ensure that medical costs don't erode the nest egg you've worked hard to accumulate. This comprehensive approach to healthcare planning is more than a financial decision. It directly impacts your comfort, independence, and peace of mind in later years. Rather than viewing insurance as an expense, consider it a strategic layer of protection, potentially saving you thousands of dollars and countless hours of stress when an unanticipated health crisis emerges. Reviewing insurance policies might feel repetitive, but each annual check-in allows you to catch changes early, compare competing plans, and spot ways to preserve funds or enhance coverage. The best healthcare planning also anticipates that medical needs will shift over time, so staying flexible and ready to adapt keeps you one step ahead of rising costs and new conditions. When you combine strong insurance coverage with a solid understanding of eligibility requirements and ongoing wellness efforts, you establish a powerful shield against the unpredictability of medical expenses. Should you find gaps in coverage, reevaluating your priorities and finances can reveal whether you can reallocate funds to fortify certain areas, such as upgrading to a comprehensive dental plan or buying a more robust Medigap package. These healthcare considerations link closely to your overall retirement framework, because an unplanned medical crisis can derail even the most well-crafted financial plan if not properly insured. Ultimately, securing healthcare and managing insurance plans effectively forms one of the critical pillars of a stable retirement, ensuring that the later years of your life remain not only financially sustainable, but also dignified and comfortable for you and those who care about you. Tip 4. Explore ongoing growth, learning, and lifestyle strategies. Sustaining both financial and personal well-being in retirement often hinges on your willingness to keep exploring and growing, even after you have left the traditional workforce. At age 60 or beyond, it's easy to fall into the mindset that your career, learning opportunities, or ability to adapt are at a fixed endpoint, but this doesn't have to be the case. Many retirees find renewed vigor and purpose by taking on part-time work or even launching a small business that aligns with their interests or talents, ensuring not only extra income, but also social engagement and mental stimulation. Continuing education can take numerous forms, from enrolling in community college classes or online courses to attending workshops on subjects that excite or challenge you, like gardening, painting, coding, or even personal finance. If you're open to a more global perspective, you might explore educational travel programs that combine sightseeing with structured learning, often enabling seniors to deepen their understanding of history, art, or culture while forging new friendships. Volunteering can be a highly fulfilling avenue for growth, too, allowing you to offer your expertise or learn new skills while making a tangible difference in your community. Many organizations actively seek out older volunteers for mentoring roles, taking advantage of the professional and life experience that retirees bring to the table. Beyond formal education and volunteer work, you might also consider practicing new hobbies, everything from pottery and photography to dance and yoga, that can help keep your mind sharp and your body active. Social connections, both online and in person, play a critical role in maintaining mental health and emotional well-being. So nurturing friendships and seeking out new social circles can be just as important as any financial strategy you employ. Retirement can be an opportunity to rediscover interests set aside during your working years, whether that means immersing yourself in the arts or spending time in nature through hiking, birdwatching, or gardening clubs. Physical activity is a cornerstone of a thriving retirement, and you don't need to engage in intense sports to reap the benefits. Walking clubs, Tai Chi sessions in the park, or water aerobics classes can help maintain mobility and health in a supportive environment. If travel appeals to you, building a realistic travel budget into your retirement plan allows you to explore destinations you've always dreamed of, creating memories that enrich your sense of fulfillment in these later years. However, balancing these pursuits with your financial constraints is essential, meaning you should periodically revisit the budget you established in earlier steps to confirm you're not overspending on recreation or leisure. Technology can be a valuable ally in your post-60 endeavors, with countless apps and websites devoted to skill development, language learning, and event networking, enabling you to stay connected and intellectually active. Cultivating an adaptable mindset helps you transition gracefully if circumstances change, like deciding to move closer to grandchildren, downsizing your home, or pivoting your volunteer efforts to a new cause. Exploring spiritual or mindfulness practices, such as meditation or yoga, can also add a sense of peace and centeredness, contributing to better mental health and potentially easing the anxieties that often accompany major life transitions. Many retirees find that building a flexible routine, a blend of daily habits and open-ended time, helps them maintain a sense of structure without feeling confined, and it can optimize productivity in hobbies and learning projects. If you have a talent for writing, you might even consider authoring your life story, creating a memoir or blog that documents your experiences, insights, and lessons learned, potentially inspiring younger generations. Engagement in cultural and civic events, whether by joining local councils, clubs, or simply attending community gatherings, can keep you updated on issues that matter to you and foster meaningful interactions with people of all ages. Pet ownership is another avenue for enhancing quality of life, providing companionship, daily exercise, and a structured sense of responsibility that can fill your days with small joys and a sense of purpose. Pursuing self-expression through the arts, be it painting, quilting, singing, or any other medium, cultivates creativity and can help ward off stress, depression, or isolation by involving you in a supportive community of fellow enthusiasts. For those with a strong business background, consulting or offering mentorship to young entrepreneurs can be a natural extension of your professional life, allowing you to remain active in your field without the demands of a full-time schedule. A willingness to embrace technology can also enable remote opportunities, such as online teaching, e-commerce ventures, or freelance work, providing flexibility that accommodates a slower-paced lifestyle while still creating meaningful engagement. If you have a network of like-minded retirees, forming small discussion groups, book clubs, or social clubs can create a regular and enjoyable rhythm to your week, blending intellectual stimulation with social bonding. Although you may not be working full-time, setting personal goals, like reading a certain number of books per year, learning a new language, or mastering a musical instrument, adds a sense of direction that keeps life fresh. Documenting your retirement journey in a journal or digital platform can help you track your progress, reflect on your growth, and adjust your plans as you discover new possibilities. Staying connected to friends, family, and communities through social media or group messaging platforms can also nurture emotional bonds, especially if you live far from your loved ones. For those concerned about potential loneliness, co-housing arrangements or senior living communities can strike a balance between private living space and shared common areas that foster ongoing social interaction. Addressing emotional well-being with as much care as financial management is key, so exploring support groups, therapy, or spiritual counseling is entirely valid if it enhances your overall sense of contentment. Maintaining open communication with your partner or family members is crucial, as their expectations for retirement might differ, and finding common ground can prevent misunderstandings or resentments. This phase of life can also be the perfect window to share your accumulated wisdom with younger generations, whether informally around the dinner table or by hosting workshops at local community centers. Watching the positive impact of your experiences on others can reinforce your sense of purpose and underscore how retirement is not merely an ending, but also a meaningful transition with abundant opportunities. Even small lifestyle modifications, like scheduling coffee meetups with old colleagues, joining library reading circles, or taking part in a local nonprofit, can create a sense of belonging that enriches your day-to-day routine. If financial constraints limit your recreational options, look for free or low-cost community activities, such as city-sponsored adult education classes, library talks, and local museum days, which can offer cultural enrichment without a heavy price tag. Structuring your time in retirement can involve a gentle balance between relaxation and purposeful engagements, ensuring you don't lose momentum while still enjoying the freedom of a less rigid schedule. The overarching principle is to retain a proactive approach, seeking new horizons, addressing challenges, and celebrating personal growth, rather than drifting into a sedentary or unmotivated lifestyle. Ultimately, this final key point embodies how to maintain the vibrancy that allows you to get the most out of the financial security you've built, ensuring that every day has the potential to be meaningful. With this holistic focus on health, learning, social relationships, and purposeful action, you'll not only safeguard the stability of your golden years, but also maximize the sense of fulfillment, creativity, and connection that can define a truly rewarding retirement. On your screen, you see 2 new videos that I'm sure you'll find helpful. Just decide what you want to see and click.